They're just good minds. That
Around that.
That time.
Oh, we got married.
A buddy of mine from home. So. Yeah. The wedding circuit. I got one more. Good. So
That's it. None of my friends have, actually, one of my extremely good friends, Ian, who actually graduated from Stern last year. It's proposed to his girlfriend this weekend. It's not gonna be a surprise. Yeah, I'm not a part of, I have no logistical responsibilities, but yeah, it's gonna.
Yeah, a little space.
And he'll be the first of my good friends to get married.
You should have got your valuations back if you sent them with the right subject. If you did not, they're lost in the 2,000 emails, so send them again. So it's been, I've had roughly 2,000 emails in the last 10 days. So I have no idea where it's lost.
Yeah.
Right? I should have been clearer on what I want title my perfect DCF. A lot of people titled their valuation spreadsheet my perfect DCF, which really doesn't help much when I screen. I just need the subject to be my perfect DCF, so it went to the right mailbox. But I think we've got most, my rough count was 357 DCFs. So, there are about probably 50 people who never turned in a DCF. More than that, it's closer to 400 DCFs by the time I was done. So I'm sure there are people who did not turn in a DCF, and if you haven't and you still want feedback, I will give it to you. So get it in. Don't wait till May 4th, please. No, that'll be a little close to the end. So do it as soon as you're ready to turn it in, right? So today I'm going to kind of hit two things towards the very end. Last session, as you remember, we could not get the projector up. So I was kind of, winging it based on what was in the slides. But today there are two things towards the end of, and I gave you the video from the undergraduate class because that did have the video and it's pretty close to the same material. There are two things I did toward the end of the class that I'm going to start this class off with as tests. Now, one of my favorite things to do at the start of every year is to take the 100 largest market cap stocks in the US and take their price to book ratios. Okay? What's a companion variable for price to book? You're a week away from the quiz. So what's the trick we use for an equity multiple to get the companion variable? You divide net income by the denominator of your multiple, right? Net income divided by book equity is return equity. So price to book return equity. And I did a scatter plot. Remember those from statistics? Basically, you take each company, you plot it out. There are 100 companies on this graph. And then I seem to have drawn 3 random lines through, but they're not quite random. But this line that you see there is the best fit line. It's just no OLS, it's a regression line. You know what the 2 outer lines are? When you run a regression and you get predicted values, you also get standard errors. Those are the 90th percentile in terms of, so everything that falls within those 2 lines, I cannot statistically reject as being fairly valued. So, which should make sense, right? 100 largest market cap stocks, most should fall within the line. But take a look at the stocks that fall above the line and the stocks that fall below the line. First, if I were just looking at price to book return equity, where are my overvalued stocks? Above the line, below the line? Mike? Above the line. So let's go through some. There's MasterCard, there's Apple, Eli Lilly, Palantir, CrowdStrike, this Trade Desk, I think is TTD, Snowflake, and that absolute basket case of a stock, which is MicroStrategy. I don't even know what it is. And there were 2 people in the undergraduate class who picked MicroStrategy, and they very quickly, I got them to change the company. Because what's your story for MicroStrategy? Everybody familiar with MicroStrategy?
Ever Bitcoin play?
It's a Bitcoin play. There's no business left anymore. It's basically your bet on Michael Saylor being able to predict where Bitcoin prices are going to go, which makes it almost impossible it's a trading device for Bitcoin. So but they might be overvalued, but what's the other explanation you can give for why they will fall above the line, even if they're not overvalued? Remember, the drivers are price to book. Return equity is the companion variable. But what else goes into the mix? You have growth. Higher growth companies should have higher price to book. You have risk. Higher risk companies should have lower price to book. And in this case, what might explain all those? What do those stocks collectively above the line? What do they generally share in common, you think? What's the one? Probably high growth stocks, right? Is there a way I can bring growth into this scatter plot? Or have you seen a three-dimensional scatter plot? It looks like a box, right? It'd be price to book, return equity. It's kind of messy, but what you're looking for again is that combination. And you can already see why we end up with regressions is you can get dizzy looking at these things. And a fourth dimension, forget about it. You can't have four-dimensional scatter plots. You'll have multiple scatter plots across. So it's a very good starting point where you can say, hey, look, what's the only stock that looks undervalued? Start of 2025. Oracle. Interesting, right? The technology company and see Home Depot that's at 5. I actually had to cap it at 5. Its price to book is now about 5,000 because its book value of equity had become so small because of the buybacks. Price to books are getting more and more difficult to use as buybacks drive book values of equity to negative territory and beyond. Oh, and so it's gone back and forth with this negative book value of equity, making it very difficult to even think about the book value market. So that's the first. The second test I'm going to run is actually on a grocery business. And I'm going to take you back to 2007. And grocery business are incredibly boring. So usually the analysts who work in this business are used to companies with low margins and low growth. And they use the same multiple, EV to sales, or everybody trades around point. And then in 2007, there's a new kid in town. Whole Foods had just gone public, and analysts didn't have any idea what to do with it. It was a high growth, higher margin. I mean, it's not Ann Taylor type of margins, but it's margins much higher than they used to. And they just threw up their hands and said, we have no idea what to do with Whole Foods. See what it says? Way above everybody else. But they explained away, it's higher growth. So in 2007, I actually put in Whole Foods higher margins and said, even with a higher margin, I can't explain where Whole Foods sits. If you get a chance, look at the next 4 graphs, because I track Whole Foods in 2009, 2012. And as you go through time, what you'll see Whole Foods doing is going from overpriced to underpriced to finally ending up right on the line. And there's a broader message there. When a company comes into a sector that's unusual and analysts are not used to dealing with that type of company, they'll misprice it. Tesla, when it first got listed, tremendously mispriced, still mispriced, but it's tremendously mispriced, which is an opportunity if you're an investor, right? The time to pick these companies is when people have no idea what to do with it because it's so different from everybody else. Airbnb in the hospitality business, right? At least there you had Booking and Expedia out there as comparisons. But when you see a company where you can't find comparisons right now, that might frustrate you, but at the same time, it means your intrinsic value carries more weight. So I'm going to move forward to page 79 and talk a little bit about companies. And this is especially directed to those of you doing negative earnings companies trying to price your company. Remember how your life was difficult when you did intrinsic valuation? Your life will also be difficult when you do pricing. First, if you have a negative earnings company, already you're getting desperate, right? The only multiple you can probably get to work is a revenue multiple. So this is in 2000 when I valued, remember I showed you the intrinsic valuation of Amazon that I did where I overvalued, found Amazon to be tremendously overvalued. At about the same time, I decided to price Amazon. .com company. So this is the scatter plot of .com companies of price to sales. I mean, I should have used enterprise value to sales in hindsight. Price to sales against net margin. When you look at the scatter plot, what's your reaction? Trying to fit a line through it is going to be a nightmare, right? It looks like we talked about shotgun blast. This is a shotgun blast. There is no discernible relationship between the two. And don't be surprised if you see this with your negative earnings company, especially if it's a young company. You look at the peer group, you pull up the numbers, no real. So I'm going to give you a couple of things you can try that make sense. Initially, here's what I did. I decided to run a regression anyway, price to sales against net margins on that scatter plot. And the statistics said there's no relationship. The R squared is 0.04. And the scarier thing was, look at the coefficient in the net margin. Minus 7.54. How would I read that? What is that telling me? In this sector, the more money I lose, the higher the multiple of revenues I would trade at, which if I'm writing a book on irrational exuberance, would be exhibit 1, right? Look at how crazy people are. But you know what? That's a dangerous place to be when you start with the presumption people are crazy, and that's why they're doing this. Let's face it, nobody was pricing Amazon or any of the .com companies based on how much money they made last year, right? Let's play it out. Why were they buying companies? Because they expected high growth in the future, and that eventually these companies would survive and make money. So I decided to reframe, and this is the first thing you can do, is rather than running the traditional regression, price to book against return equity growth payout, you think about why would people pay a high price to book or a high price earnings? And here I started with 2 hypotheses. The first was higher revenue growth companies should trade at higher multiples of revenues than lower. So because we're a lower growth company, I'd pay a lower multiple. Second, I also assumed that as your revenue scaled up, your multiple would have to go down. It's one thing to pay 500 times revenues with $1 million revenue company, but those revenues become $1 billion and 10 billion, you're going to see a scaling down. And there's a third and final factor, which reflects the fact that these are all young companies. What happens to most young companies? You track them over time, they disappear, right? So there's got to be a survival factor that people are factoring in. And I'll throw out a hypothesis. When you look at young companies failing, it's almost never because they have debt. It's because they run out of cash. So here's the third variable I'm going to bring in. The more cash these companies have on their balance sheet, the more likely they will survive. In fact, the peak of the dot-com boom, analysts used to track how many months of cash companies had on their balance sheet. And if they had more months of cash, they were given a higher multiple. So here's what I did. I ran a regression of price to sales ratios, and this is desperation rearing its ugly head. I said, look, nothing is working. I want to try to explain why revenue multiples are what they are. I took price to sales. I threw in the level of revenues, log of revenues. One of the tricks you can use whenever you run these multiple regressions, if you have a variable where there's a big difference between the lowest and the highest number, just take the natural log. I know a statistics professor would kill me for saying this because it seems like a bludgeon approach. 95% of the time in finance, when you have too big a variation in one of your independent variables, throw the natural log. It'll make them closer. So that's basically what the log of revenues captures. The revenue growth rate is that because higher growth companies should have higher price to sales. And the more cash these companies have, the higher. So at least the coefficients are all in the right direction, plus 5.11, plus, and the higher the revenues, the lower the price to sales ratio. If I were running this regression, I'd probably take the log of revenues out of the regression because the T statistic is not significant. But I'm going to leave it in here because I already ran the regression. So I put in Amazon's numbers into this regression. Log of Amazon's revenues, its revenue growth, and how much cash it had. I got a predicted price to sales ratio for Amazon of 30.42. It was actually trading at 25.63 times. And that's a bit of a contradiction, right? Because just before I did this, I did the intrinsic valuation, and I concluded it was significantly overvalued. Now I'm running a pricing and concluding it's significantly underpriced. How can both be true at the same time? What do you want to try? How can a stock be both undervalued and overpriced at the same time, or overvalued and underpriced at the same time? France, you want to try?
Maybe.
Well, why isn't it why in both places? Why is it a bubble in one in the intrinsic valuation, but not in the pricing? Yes.
The things you're comparing it to are also contractually overvalued.
In fact, there are two separate questions I'm asking, right? In intrinsic valuation, what's the question I'm asking?
How much is this individual asset worth?
Given its cash flows, growth, and risk, is this stock under or overvalued? And we conclude it's overvalued. In this pricing, what's the question I'm asking?
Expenses just relative to other similar.
Given how other .com stocks are priced, is this stock underpriced or overpriced? And this is where the bubble argument comes in. If you have a sector where everything gets pushed up, you can have something look cheap relative to the sector, but overvalued on an intrinsic value basis. So some of you might find this when you do the valuation, your intrinsic valuation says your stock is overvalued, but when you do the pricing, it's going to come out as cheap. Don't sit there pontificating about deep stuff. This isn't deep. You're asking two separate questions. You got two separate answers, and you got to decide what to do. If you're a trader, you'd go with the pricing answer because you want to make money off the pricing. If you're an investor, you go the intrinsic value answer. One is not better than the other. They're just different perspectives you bring to the market. Okay? So that's one strategy. So take your sector, see if there's something you can use to explain the differences. Here's the other. One of the reasons you're having trouble pricing your company is because you're looking at today's numbers. Right? So when you look at today's numbers, those numbers are really small. The company has small revenues, small earnings. So here's the other tactic that analysts often use. Rather than look at a multiple of revenues today or a multiple of earnings today, they project those numbers out 5 or 10 years out and look at the multiple you'd pay for revenues in year 10. Kind of a dangerous game to play, right? But that's basically, it means that you can now use price earnings ratios because 10 years from now, your company is expected to make earnings. Two things to remember. If you do this, you got to do it for all the companies in your peer group. You can't just do this for your company, right? Which is not that messy because I think Capital IQ gives you forecasted revenues for your company at least 5 years out. It's called a forward multiple. So here's how it'll work. Let's suppose your company is a small company right now. It's an EBITDA of minus 100 million, but you expect it to have EBITDA of 500 million 10 years from now. Let's say mature companies in your business trade at 10 times EBITDA. 10 times 500 gives you 5 billion in year 10, right? Can I compare that to the market cap today? The 10 billion is what I expect this company to be worth 10 years from now. First, I have time value of money to factor in, which is the market prices today. This is 10 years out, so I've got to discount the 10 billion back. The other thing I've got to factor in is I have to live 10 years to get to year 10. And during those 10 years, what do my cash flows look like? Usually big negative cash flows. There's a present value effect. And if there's a failure risk, that's got to be factored in as well. I see analysts using forward multiples all the time, not correcting. They might do the time value part. They won't correct for failure risk. They're not correcting for negative cash flows, which means you're going to overvalue companies using forward multiples because you're not factoring in the noise. In a very early valuation of Tesla, this was like 10 years ago, I had a terminal value in my valuation of 69 billion, which was well above the market cap at the time. And I concluded the stock was overvalued then. And I got pushed back saying, but you gave us a terminal value of 69 billion. That's so much higher than the market cap today. Why can't I call it undervalued? So basically, I took the 69 billion and essentially stepped it down with each adjustment. First, I said, if you just discount back at the risk-free rate, you lose 2.05 billion. You discount back at the risk-adjusted cost of capital, you drop to 28 billion. You adjust for the fact that you have negative cash flow. So by the time I was done adjusting for all of that, that forward value became a current value of 8.2 billion. It's a good way of illustrating how forward numbers kind of lose steam as you adjust for each of those factors. So if you have a money-losing company, you can either try what I did with Amazon and see if you can find something that explains the differences, or use a forward multiple, but then remember to try to at least adjust for the failure risk and the other issues you brought up during the intrinsic valuation. So, yeah, go ahead, Matt.
I
I saw that you adjusted for the dilution by new equity issuance.
Because we're not doing a discounted cash flow valuation, right? And the discounted cash flow valuation gets done for you. That's why we didn't care. When you're doing pricing, we haven't factored that in, right? So here you have to explicitly adjust for dilution. Because if you don't, you're going to end up, so the dilution effect here is just take the negative cash flows, discounting the back. The alternative is you can take the value and divide by the total number of shares you will have outstanding with the diluted shares issued. Do one or the other, but you have to factor in dilution explicitly or you'll overvalue the company. Right? So ultimately, pricing is about playing by the market's rules. It's not what you think or I think should matter. It's what the market thinks should matter. So about 10 or 15 years ago, when user and subscriber-based companies kind of took off, Facebook and Google and transaction-based, some were advertising-based. One of the challenges you face was people were computing market cap per user for companies. And the question is, what do we control for that? So here's October 2013 was when Twitter went public, and I wanted to price Twitter. I'd done an intrinsic valuation of Twitter. I wanted to price it. So I collected data on other social media companies that got much of their value from online advertising, because that's where Twitter got its value. So there's the market cap of these publicly traded companies. LinkedIn was a separate company then. Microsoft hadn't bought it then. There's the enterprise value. And then I collected accounting data to see if any of them would explain the differences in market cap across these companies. I collected revenues, EBITDA. None of them had much correlation with market cap until I got to the number of users. So you can compute enterprise value per user. So here's what I did. I computed the correlation between the market values I got for these companies and all of these variables. Because I could sit there and say revenues matter, EBITDA matters, but the market has a very different view of this. If you look across, correlation with number of users is almost 1. You tell me how many users you have as a company, I can pretty well predict what your market cap should be. So you know how I priced Twitter? It had 240 million users when it went public. I multiplied it by roughly $100 per user, which is what if you look at the previous page, 97.41, rounded up to 100. 240 times 100 is 24 billion. I'm done. This is pricing 101, right? You know what? That's roughly what it went public at, is roughly 24 billion. Sometimes we overcomplicate pricing. The question we should ask is, what is the market looking at when it prices companies? And it's purely data-driven question. It's not driven by theory. And once you've identified it, you got your pricing. I know some of you are valuing young biotechnology companies and pharma companies. What do you think the market pricing? I mean, obviously, it's not based on current revenues and current earnings. What do you think drives the differences in market pricing across them? You want to try, Nikita?
It's whatever drug they have in the pipeline, potential population.
That's basically it. It's total market. So if you have a drug that can treat diabetes and it looks promising, you're going to get a much, much higher pricing than for a disease that only a few thousand or a few hundred people do. So that's what you'd collect at. To price these companies, you'd have to get a sense of what the total market is for the drugs they're trading. And maybe it'll work, maybe it won't. You have to leave the door open that you could have a great hypothesis, but the data says, no, it's not working. You got to be willing to abandon it. But that's what you start with. If I were somebody buying the stock, what would I look at? And then you try to extrapolate from that to see what drives difference in pricing across companies. So we kind of covered a whole spectrum. You have a follow-up question, Nikita?
You also use this logic for something like Uber or DoorDash, which is like an.
That's a good question. Well, what do you think ride-sharing companies are price-based? So now they have more substance, right? Now they have revenues and users. But before they had revenues, obviously you had to base it on something. You probably based it on riders or people using it. But I think at some point you got to move on from that. In fact, even within that space, you went from users to active users because investors discovered you could have hundreds of millions of users, many of whom never come on your platform. They're on your platform, but they never use it. So they went to active users and they went to monthly active users because you could have active. So you could see even within the user space, things getting, I won't call them more refined, more focused. And eventually you got to leave users behind and have revenues, right? That transition has to happen somewhere because users by themselves, neither here nor there. So they,
How would you apply that biotech logic of market size to young biotech companies that are maybe doing R&D in the orphan drug space or very, very niche?
you're buying options there. You're not even buying a business, you're buying an option. It's an option. But even there, I'll have to find out what you're doing. I mean, even basic research is directed somewhere, right? If you said, look, I'm doing basic research, but I have no idea what diseases will treat, I'm not funding you. Not now, not ever, right? That kind of research should happen at universities if they get the funding, but basically research, because I need some focus on where the research is going to attach a number. And that's why even very basic research, I'm looking at where are you going with this research eventually. Yes.
If you're pricing based on the number of users, how do we bring in the pricing power that the company might have?
You'd use number of users because that hasn't shown up yet, right? Because if you take these companies now, I'm no longer pricing them on number of users. Eventually what happened here was Facebook started, if you look across the users here, Facebook, you're paying, let's say it's 130, but you also have, TripAdvisor 49, 46. What you'd have to do is you then have to bring in things that you think will explain why people are paying more per Netflix subscriber than for a Facebook user. It might take the form of Netflix as a subscription model. So you can start adding things that explain why you have differences in per user or per subscriber prices and bring in this. It's all data driven again. There's no theory driving it. But the advantage if you start with an intrinsic value base, you can at least ask, why would I value user higher in one company than another? Okay. You know what I throw in here? I throw in the number of minutes people spend on a platform, which is actually in the public domain. You can see, I don't know how they know, but it's scary that they do. 57 minutes on Facebook, 6 minutes on Twitter. Already you can start to explain why a user in one platform is worth more than another if you have an advertising business. So all of these examples I've given, I picked a sector, I picked a multiple, and I've tried to explain whether a company is cheap or expensive relative to a peer group, right? But if you think about it, if you can control for differences in risk and growth and cash flows, I don't need to stay focused with a peer group. I can compare a company to the rest of the market. I should be able to compare a utility company to a software company if I can control for differences in cash flows, growth, and risk. Remember, investors don't buy sectors, they buy a collection of cash flows. That's what you're getting when you buy a stock. Right? So here's what I'm going to try to do. I'm going to try to extend my comparison to the entire market. In a sense, you're asking a different pricing question. You're asking, is Amazon cheap given how the rest of the market is priced? And that answer can be different from, is Amazon cheap relative to other .com stocks? So here's what I'm going to start with. I took the entire US equity market. And this regression I've been running for 30 years. I have the regressions going back in time. What's a companion variable for PE? It's expected growth, right? Net income in the future divided by net income now. I start with a scatter plot. Why? And the reason I start with the scatter plot is I don't want to get my hopes up too high. If this is the most significant variable, I am in deep trouble already when I run the regression. Right? You don't get this nice, neat line where every point is on the line. Clearly, there's a lot of noise in this process. This is PE versus growth. I still ran the regression of PE against growth rates, payout ratios, and beta. And you can see why I picked those three, right? If you go back and look at what drives PE ratio, those are the three variables. So this is not a kitchen sink regression where my objective is to get the highest R squared. I want to see what fundamentals do to explain difference in PE. Let's start with the R squared, 24.4%. Am I happy? No, it's not. I'm neither happy nor unhappy. It is what it is. PE ratios are really difficult to explain differences across. And so if you use PE ratios, you need to be aware of that. It's a noisy multiple. There are the three variables, expected growth, payout, and beta. First, let's look at the coefficients. 51.92 on growth rate. Every 1% increase in growth rates for US companies at the start of 2025 increases my PE ratio by 0.52. So if your company has a growth rate 10% higher than mine, your PE ratio should be roughly 5.2 higher than mine. So that makes sense. Higher PE ratio, payout ratios feed into a higher PE. Again, that makes sense. If you, for any given growth rate, you're able to pay out more of your earnings as dividends, you should be worth more. I mean, then I get to a beta and I have a problem. Do you see what the problem is? In theory, at least we work out the intrinsic value equation, as beta goes up, what should happen to PE ratios? Risk goes up, PE should go down, right? For God's sakes, don't go in and put in a minus there because that'll make more sense. It is what it is. The data is saying across US stocks, higher beta stocks have higher PE ratios than lower beta stocks. How would you explain that? Makes no sense, right? Why would higher risk? There's a statistical reason. And that requires we remember things about multiple regressions we've been trying to forget for a very long time, right? First, remember, when you run these regressions, you're assuming linearity. Right? That's not the reason for the wrong coefficient, but you run a linear regression. In today's statistics packages, if you don't want that linearity, there's a way we can get around. We'll talk about it, but we're assuming linearity. Second, we're assuming stationarity. What does that mean? That things don't keep shifting on a monthly because you are running a cross-sectional regression. And there's a third requirement when you run a multiple regression, which is the independent variables are supposed to be independent of each other. It's supposed to be uncorrelated. Is there a way I can check to see if they're uncorrelated? Absolutely. I ran a correlation matrix, and you see very quickly why that uncorrelated part. Before I do that, though, when you see any of these, when you run these regressions and you see the t statistic and the t statistic doesn't hold up, just take it out of the regression. It's better to run a clean regression with coefficients that matter rather than push them all. So don't sit there saying, this is supposed to matter, so I'm going to leave it in there. But one of the things that I've run into with these regressions that I did not run into in 2025 is sometimes when you run the regression, you can get a negative intercept, which means the slope of the line was steep and you're saying, so what? If you have a negative intercept, there is a possibility that when you get a predicted number from this regression, that predicted number can be negative. And that's a problem for me. Why? Because PE ratios are not supposed to be negative. There's a fix for this. In almost every regression package that you open up, Minitab, SPSS, or even in Excel, it allows you to take the constant out of the equation. You say, why would I do that? Here's why you do that. If you have the intercept be negative, the easiest way to fix it is to set the constant to 0. So it forces the line through 0. It's a less good regression in terms of fit because you forced it through 0, but you no longer have that problem, the intercept driving predicted values to negative numbers. I mean, none of you might have to run a market regression, but it's actually kind of fun with the data. If you ever have to try a statistics exercise, take all the companies, you can download them from Capital IQ, run the regression, see what you get as the R squared and the coefficients. But here's the thing that showed me that I had a problem. So remember the requirement that your independent variables be uncorrelated with each other. When that requirement is violated, you have what's called multicollinearity. I remember my statistics class hearing that and saying, who cares? And then I ran this regression and said, I should have cared more. Multicollinearity basically means when you have independent variables, in this case, payout growth and beta, all of these numbers that are not on the diagonal should be 0. And if you look at the actual numbers, expected growth is higher for riskier stocks, which makes sense. Higher growth stocks have higher betas and lower payout ratios. You're saying, so what if they're correlated? What does the computer see when you run a regression? It sees 4 columns of data, right? You might have labeled them, but it doesn't care what the labels are. It sees 4 columns of data. Let's say all your high growth companies also have high betas. You see how the computer is going to get confused? Beta becomes a proxy for growth rather than risk, and you get that positive coefficient. And what should we do about it? Probably nothing. Because the coefficients are tough to read, but the regression itself still works as a predictor. You can use the overall regression. Don't overread the coefficients because the coefficients are going to be messed up by the multicollinearity. So I'm going to leave the regression as is, recognizing that the individual coefficients are messy, but that the overall prediction works. So in a sense, that's what all of quant investing has become. This is a very simplistic statistical tool, as you know, a linear regression with three. But you could make this non-linear. You could add in other variables. You can add social data in if you can find a way to classify them to be numerical. And that's become this entire process of quant investing and active investing is bringing the data in, trying to see if you can come up with this master regression across the data that'll tell you what stocks should be priced at. Because once you get the regression, you can price any stock in the market, right? You plug in that stock's beta growth rate. In this case, I took a Disney growth rate of 15%, beta 0.90, 20% payout ratio. You plug it in, you can get a predicted price earnings ratio for any company. Compared to the actual PE, the actual PE at that time is 40.4 times earnings. Your conclusion would be that Disney is overpriced. But remember, the nature of this regression is you're going to get half of stocks be underpriced, half be overpriced. You can put in, 90%, confidence intervals. You could be a one-person hedge fund, buy the 10% on each side that are underpriced or overpriced, and hope they move to the regression line. That's the allure of quant investing, is if you can build that master regression and then pray and hope that the market moves towards that master regression, you're effectively making money on both sides of the mispricing. One of the things I've tracked every year is that coefficient on growth. It is 0.52, I think, this year. Let me go back and see where it was. 0.52, which means for every 1% growth, I'm paying 0.52. Think of that as the price for growth. Do you have a price for risk as well that we've been tracking? It's the equity risk premium, right? So let me show you what the two numbers have done together over time. So you go back to 2000, there's the price for growth. Markets were paying a huge amount for growth and not charging very much for risk. That's a 2% equity risk premium. So if you're a high growth, high risk company, this was nirvana for you. You're trading at 200 times earnings. Over time, if you track those two numbers, they kind of give you the ups and downs of markets. And periods when markets get scared, the price of risk shoots up and the price you're willing to pay for growth drops off, 2008, 2009. Where do we stand in 2025? The price of risk is high relative to where it was in 2000, lower than it was a year or 2 or 3 years ago. But the price you're paying for growth is not outlandish relative to history. So it's a number I track over time because it might give me an indicator as to when you're getting this mismatch in the price of risk and the price of growth. That comes directly out of the regressions. I'll do one more multiple, just kind of talk about a multiple that doesn't fit the linearity assumption as neatly. Remember we talked about PEG ratios? PEG ratios are messy. This graph, I've taken PEG ratios and graphed them against a growth rate because it turns out growth doesn't disappear. So that's what the PEG ratio looks like. I might be just seeing things, but doesn't it look like there's a bit of almost a curve to it? I know this might be just my imagination, like cloud watching. After a while you watch clouds, they can look not like cloud data, but the actual clouds. You can make them look like whatever you want them to look at. So I did the natural law. I think this looks much better from a linearity assumption. If I have to fit a line, I have a chance of fitting a straight line through this. There's no chance I could fit through the previous one. One of the things you can try when you have a multiple is start with a scatter plot. And if you see something that looks like the PEG ratio, try the natural law. It actually does amazing things to make the relationship more linear. So in the case of PEG ratios, I ran the regression with log of growth as my coefficient for growth. So it's just a natural law. Regression, terrible R squared again, 0.15, but that's the nature of PEG ratios. It's tough to explain. Beta is positive coefficient, but the multicollinearity is just slurring you. Payout ratio positive, log of growth is actually negative. Higher growth companies have lower PEG ratios, at least in the cross section. PE ratios and PEG ratios have always had the most trouble trying to explain the lowest R squares. It improves when you go to price to book, EV to sales, EV to EBITDA is back and forth. But basically, when you look across multiples, it tells you some multiples are easier to explain and use than other multiples. For better or worse, people are stuck on PE ratios and they keep using a multiple that by its very nature is the most difficult multiple to explain across companies. So I'll say if the next few pages are just my updated 2025 regression. Start of every year, I run regressions for a bunch of multiples. I do. This is price earnings, cross markets. And you can see R squareds vary across markets. Same three variables in every market. Fundamentals don't change, but very different slopes on the growth across the regions. Why? Because if you want to price your company against the entire market, I don't want you running the regression from scratch. It's too much work, too messy. You can use this regression. It'll give you a third number for your stock, an intrinsic value per share, a pricing against the sector, which you'd have done. You can price it against the market. Could you get different conclusions? Absolutely. But because you're asking three different questions and getting them answered. So that's PE ratios. I do PEG ratios. Notice the log of earnings per share. And if you notice that for Europe, the payout seems to have dropped out because the T statistic was not significant. So if it's not significant, I take it out of the regression, but I always start with the same variables in every part. Right? So browse through the remaining pages because I think I've P, PEG ratio, EV to EBITDA, EV to invested capital, EV to sales. So no matter which multiple you use, if you want to price your company against the market, you can use one of these regressions. So let me cut to the bottom line on the pricing game. You have choices, right? First, you got to decide whether you're going to price relative to enterprise value, equity value, or firm value. And that's going to be determined largely by what kind of company you have. If you have a bank, it's not even a question, just stay with equity value. But if you have a firm in any other sector, if there are big differences in leverage, go with an enterprise value multiple. It's always safer. What are you going to scale it to? Revenues, earnings, cash flows? Of course, if the only number you have positive is revenues, beggars can't be choosers. You got to use revenues or revenue drivers. But if you have earnings, book value, which one is best? There is no best multiple as long as you control for differences on the things you need to control for. In terms of timing, you can use current numbers, you can use trailing numbers, you can use forward numbers, you can use normalized numbers. Just remember to do it for all of your companies in the same way. It's important that you be consistent in that choice. And if you're a cyclical company, you might decide to replace the current numbers with normalized numbers. Oil companies, rather than use last year's numbers, you might use an average over the last 10. And finally, if you look at comparables, you have to decide what your peer group should be. You might decide to go with a regional peer group. With US companies, you can get away with it because you have enough companies in the US. But if you're doing Turkish companies, you might have no choice but to go across Europe or even global because you will not get enough companies in your peer group. Okay? So make your choices. There's no right choice because once you made the choice, it's just important that you do all your companies on that. And if you start losing a lot of companies based on your choice of multiple, go back and pick a different one. Pick PE and 2/3 of your companies are gone because of negative earnings, switch, do something else, which brings more companies into the mix. So here are my bottom line propositions about pricing. None of them should be surprising at this point. First, in a pricing, remember when you tell me something is cheap or expensive, it has to come with a qualifier, which is, what did you compare it to? Telling me something is cheap or expensive on a pricing basis is incomplete until I look at what you compare it to. Second, let's face it, there are no comparable companies. There will always be differences on cash flows, growth, and risk. The question is whether you choose to ignore them or choose to control for them. I gave you, if you want to use statistics, do so. If you feel uncomfortable using statistics, you still have to figure out another way of controlling for differences, because otherwise you're going to be picking stocks that look cheap, but also deserve to be cheap. Right? So It's a pricing game. And if you do it well, that's at the basis for almost 90% of what happens in markets right now. It's trading, you're pricing things, you're hoping it works out. I'm not attaching a judgment to pricing. It's just a different game. Okay. Any questions about pricing in general? Define, describe, analyze, apply, right? Define, remember the consistency principle, make sure they're uniformly estimated. Describe is look at all the data, do a histogram, get a sense of what's high, what's low. Don't fall for rules of thumb. Analyze, do that intrinsic value equation, equity multiple for DCF, dividend discount model for an equity multiple, a free cash flow to the firm model for an enterprise value multiple, so you know what variables to control for. And only then apply. Define, describe, analyze, apply. So that's pricing. Let's talk a little bit about asset-based valuation. Sounds mysterious, but so far we've been valuing entire companies, right? In theory, there is no reason why we can't value individual assets that the company owns and add them all up. It's called asset-based valuation. A lot of accountants prefer asset-based valuation because they like balance sheets. They start with each item. How much is that worth? How much is that worth? So here are the scenarios where you might have to do asset-based valuation. First is, if you're doing a liquidation, you're not selling the company, you're selling individual assets. You got to value the individual assets, right? The second is we are doing fair value accounting. And I thank my stars that I don't do fair value accounting. You have no choice but to value individual assets, right? Because you got to come up with a balance sheet. And the third is if you're an active investor or an activist investor who wants to buy a company and break it up, you need to do asset-based valuation because you're selling the pieces off. So let's put that on the table. Sometimes you got to value assets, you're not valuing the company. There are three ways in which you can value the assets of a company. And if this sounds familiar, it should. First is you can take each asset, do an intrinsic valuation of the asset based on its cash flows, growth, and risk. The second is you can price every asset based on what other assets like it people are paying. And the third is if there's some optionality, you can try to apply it there. But the third is you can trust accountants and use the book value. Would not be my choice, but a lot of some of the parts valuation, people do take accounting numbers and use it as the estimate of what the asset is worth. So intrinsic value, and that's why when I did my initial class, I didn't put asset-based valuation as a different approach to valuation because it's just applying one of these approaches to attach a number to an asset. So let's talk about when asset-based valuation is going to be easiest to do and when it's going to be messy. If I gave you a company that had 7 real estate properties on which it's collecting rental income, asset-based valuation is slam dunk, right? You can take each building, value it separately because they're separable. If I ask you to do an asset-based valuation of Disney, it's going to be a nightmare. Why is that? Even if I break Disney down into theme park revenues, broadcasting, movie revenues, why is it going to be difficult to value each piece?
Because they rely on each other.
Because there's a codependence, right? When your movies do well, more people come to your theme park. So when you have a business where there are cross-business synergies, it's going to be much, much more difficult to do asset-based valuation, right? Second, it's nice if you have standalone earnings from each asset, which real estate properties obviously fit. But when you talk about multi-business companies, an accountant might estimate earnings by division, but often it's based on allocating expenses rather than having direct expenses. And third, it is nice to have an active market for similar assets. In other words, if I want to value theme parks separately, I want publicly traded theme park companies I can use to be able to price those assets. So already you can see if I gave you the 50 largest market cap companies in the US, some are going to be easier to value on an asset-based basis and others are more difficult. So let's look at the 3 ways in which you see asset-based valuation play out. First is liquidation valuation, where you're trying to get a sense of what will I get if I liquidated the company. It's true, I can do an intrinsic valuation, but let's face it, when I'm doing a liquidation valuation, it should really be liquidation pricing, right? Because you have to sell it today at whatever people are willing to pay for it. And if you have assets that are again separable and traded, you can do the pricing, add the pricing up and say this. The one thing though is if you're in a hurry to liquidate, might you have to settle for a discount? Absolutely. So if you're doing a liquidation valuation, you can price each individual asset. You might attach a discount at the end saying, I need to get the money in the next 3 months. Who's doing Weight Watchers? Somebody in the class is doing Weight Watchers, the company. No, I'm not saying Weight Watchers isn't losing weight. No, I'm not trying to pick on you. No, Weight Watchers, the company, is on the verge of bankruptcy, right? And I read this morning that that bankers are trying to put a liquidation value. I'm not even sure what you'd be liquidating and how you'd price it, right? Because what do you have as an asset as Weight Watchers? You can have the name. I don't think anybody wants that name because it's got this taint to it now in today's day and age. You don't Weight Watchers. No. You have the list of people who are your, there's some loyal people on there. You could probably putting a liquidation pricing on this is going to be really difficult to do. But people are going to try. The second is accounting valuation. I might have told you the story about 20 years ago when the panel that was writing the fair value accounting rules came to New York and they were meeting and they said, can you come in and talk to us? And I said, are you sure you got the right guy? You know what I think about accounting, right? They said, no, we'd like to talk about fair value accounting. And I said, okay, can you send me what you're planning to do? And they sent me this FAS 157, which was the rule that was going to govern fair value accounting. And I read through the rule, and here's what I saw. I saw mention of a market participant, that basically the number you should put on an asset is what a market participant would pay for that asset in an arm's length transaction. So I sent an email saying, should you be calling this fair value accounting or should you be calling it fair price accounting? They said, what's the difference? And I said, that's the problem. You don't know the difference because this is a pricing mission. You know, much of the frustration in fair value accounting is accountants are given a pricing mission. But then what are they required to turn in to back up that pricing? A discounted cash flow valuation. Of course, it's not going to work. You're going to stretch what you're allowed to do in DCF. So when you look at fair value accounting, you really have a pricing mission, which means if you're going to put numbers and assets in fair value accounting, what should you be using? Multiples and comparables. Doing pricing right, it'll save you, think of the frustration it'll save you, in addition to coming up with numbers that actually make sense, given the mission you're trying to do. Fair value accounting has nothing to do with value. It's got everything to do with price. And the sooner we accept that, the healthier the discussion about fair value accounting will get. So it's liquidation valuation, fair value accounting. Let's talk about the only part of asset-based valuation that I'm interested in, which is investing in a way you can act on this. It's called sum of the parts valuation, where you value the individual parts of a company and you add up those parts, they're higher than the market cap of the company today. You argue the company's undervalued if you're a passive investor, and then you hope and pray that the market comes to that recognition and moves the price. The other is if you're an activist investor who plans to take over the company and break it up, there you actually act on your sum of the parts valuation. Because you say, this company is worth 30% less than the sum of its parts. I'm going to go buy it in the market, and then we'll sell off the parts. I'm not going to ask you to do this, but some of you are valuing multi-business companies, right? Could you value your company as the sum of the parts? What do you need? Let's say you're in 3 different businesses. What did you need? Michael?
We need a revenue breakdown for each segment, you need margin. And then,
You
yeah,
need
then you need cost of capital. for each.
CapEx, depreciation, working capital. In other words, you almost need full financial statements, right? And most of the time, you're not going to have it. The biggest challenge with doing sum of the parts valuation is information. The technique is the same, right? If I had full financials for every one of the Disney divisions, I could try. Okay? But even with full financials, the problem is these expenses you see in the financials are often allocated expenses, right? It's not like these. So I'm going to give you an example of a company where I was able to do a sum of the parts valuation. You're going to see what allowed me to do it. It's a company called United Technologies. I used to call it the poor person's GE. Now it's become the rich person's GE because it's actually better than GE as a company. But at that time, GE was the star, top of the market cap heap. United Technologies was a conglomerate. And here the business it was in. Carrier, which is a refrigeration systems business, Pratt & Whitney, defense business, Otis, which is elevators in most buildings, so it's construction business. UTC, fire and security, obviously security business. Hamilton Sundstrand, which is manufacturing, and Sikorsky, which is aircraft. 6 very distinct businesses. But here's where United Technologies made life easy for me. They actually broke down revenues, EBITDA, basically the numbers you wouldn't expect to see on a divisional basis. Most companies will break down revenues. About a third of companies will break down operating income. Very few do it at the level that United Technologies did. So I'm going to do 2 things. First, I'm going to try to do an intrinsic valuation of each of these businesses. And second, I'm going to try to price each of these businesses. Let's start with the intrinsic valuation. To do the intrinsic valuation, first, before I do that, let's do the back of the envelope process that analysts go through when they claim that a company is cheap on a sum of the parts basis. They're not doing valuation, they're not even doing good pricing. What they do is they take the median multiples at which companies in each of these sectors trade at, apply to the EBITDA that I got from this page, they apply the EV, so in this case I picked EV to EBITDA, I could have picked a different multiple. You multiply the EBITDA for each division by the median multiple and you come up with a, should really price of each business, you add them up. That's a sum of the parts pricing of the company. What are the flaws with this approach? What am I implicitly assuming? By now you know enough pricing to kind of pick this apart. What am I missing when I do this? Yes, ma'am.
They're assuming that it's an average business by taking.
That basically each of these businesses in United Technologies resembles the average company in the peer group, right? That's the first problem. Second is, there are expenses that they don't have in any of these businesses, like a G&A expense that's separate. They're completely ignoring it. It's almost like they assume that it'll go away if you break this company up and sell it off in pieces. But this is basically, when analysts say sum of the parts valuation, this is all they've done, applied a median pricing multiple to EBITDA or revenues. They prefer to stick with EBITDA or revenues because at least those numbers tend to be positive and add them all up. So I'm going to try to do pricing right before we do an intrinsic valuation. What does pricing right require you to do? First, you can have a different multiple for each group, depending on which works best. So I actually ran regressions with each of the multiples, picked the highest R squared. So these were the multiples that emerged as the multiples I could explain the best within each sector. And then I plugged in for each of the businesses what United Technologies numbers look like for each division, return on capital, growth rate. So I'm getting a predicted multiple for each division based on the peer group and based on the numbers that United Technologies was delivering in each business. So think of this as a slightly more sophisticated version of pricing. I'm still pricing, but I'm pricing using different multiples and using the differences between United Technologies divisions and the rest of the peer group. What I got as the sum of the pricing was about 74.23 billion. Why is it higher? Because it turns out that United Technologies divisions are more profitable, higher growth than the peer group, and that shows up as a higher pricing. Still, I haven't brought in the G&A, but think of that as a better pricing. So you got the median multiple pricing, you got this adjusted pricing. I put out the intrinsic valuation for the last step because it's messy, right? To do an intrinsic valuation of each business, what do I need? I need to estimate cash flows. In other words, if I had a FCFF simple Ginzu model, I'd have 6 or 5 different FCFF simple Ginzu models where I have a different story for each business, different revenue growth, different margins, different reinvestment. So first thing I did was I computed a cost of capital for each of the 5 businesses. You know why I'm able to do this? Because I don't use a regression beta, right? If I use a regression beta, this process breaks down. Because I use a bottom-up beta, I stayed with the bottom-up beta for each business, different costs of equity, different betas, different costs of equity. And the debt ratio, I cheated. I left the debt ratio at the company's debt ratio because they're all pretty capital intensive businesses. Not like, I expected one business to be high debt ratio and the other low debt ratio. You can see the difference in cost of capital. Fire and security has the lowest cost of capital and Sikorsky has the highest cost of capital. So I've got my cost of capital by business. To get the growth rate, I did use sustainable growth. Why? Because I was lazy. I estimated a reinvestment rate for each business and a return on capital for each business. Already you can see there are good and bad businesses in the mix, right? Fire and security might be their safest business, but it's also their lowest return on capital business. So if you take the return capital times the reinvestment rate, you're going to get the growth rate for each of these companies. So I've got a different cost of capital for each business, a return on capital and reinvestment rate for each business because I had that raw data given to me broken down. And I did 6 different discounted cash flow models, for each business separately. One of them, fire and security, I treated as a mature business because its growth rate was already less than the risk-free rate. The others I gave a 5-year growth period. None of them are really, really high growth. And then I brought them to stable growth. So essentially, all I'm doing differently here, instead of valuing one company with one discounted cash flow model, I'm valuing 6 different businesses. See, it's a real mess. You built a conglomerate, you got to be ready to value the pieces. And there are bonuses you get when you break the business down. Because you can ask, which of these businesses do I want to grow more and which one should I shrink? The answer should really come from looking at the return on capital by the different businesses. Here's the bottom line. I did an intrinsic valuation of each business, added them all up. There's my intrinsic value for the company. Do you remember what the sophisticated pricing was? It was like 74 billion. My intrinsic valuation is higher because it captures some of the nuances in the cash flows that I could not catch in my price. So I've got a blunt tool pricing, I've got a sophisticated pricing, I've got an intrinsic value. But in doing all of this, there's one number that I've kind of ignored, which I need to bring in. The company had about $408 million in unallocated G&A expense. They reported separate. I'm not going to assume it goes away. I'm not that cynical about G&A. I'm assuming these are centralized expenses that these 6 companies share. They're unable to allocate it because it's one accounting team, one inventory team, whatever it is. But those costs, I assume, would continue in perpetuity, and I computed the present value of those G&A costs. 408 million growing at 3%, which is my stable growth rate. That's a $4.6 billion drain on value because that G&A cost is going to reduce my value. So if I did my intrinsic valuation right, I'd take the 80.25, subtract out the 4,587. My DCF value for the sum of the parts is 75.6 billion. My relative valuation done right is 74 billion. If I did just the company DCF as an aggregated DCF, I got 71 billion. The stock was actually trading at 52 billion. Okay. And I think people talk about conglomerate discounts. No, this is, rather than apply a discount to your DCF, you do your DCF and then you look at the pricing and you say, look, is there that much inefficiency built in here that I'm willing to take a 33% write down on the value? Yeah. I know different points in time, companies like Sony have been targeted by activists saying you're worth more as the sum of the parts. I wouldn't take that further than I can take it because most of it is based on that very blunt level pricing of these companies. So if you see a multi-business company that you think would be more interesting, broken up, the best way to kind of address that is to actually do what I was able to do with United Technology. But your biggest impediment might be the lack of information. Yes.
So some of the conglomerates, they have the company transactions. Like, for example, the aircraft we sell to the defendants. How do you treat those intersegment transactions?
See, the problem is anytime so you're talking about within division revenues. One company's revenues will be another company's expenses, right? So one company's income will be raised, so it'll all be in the numbers already. So when you have intersegment revenues, you don't even have to bring them in because they're being counted in one business as revenues in another. So that's more informational for you to know that there's this intersection. The times that can get you into trouble is those are not from arm's length transactions. So if it's a family group company and you're selling stuff too cheap to another part of the company, then you can get a reallocation of value. So the effect will be you'll value one business too much and another too little if those prices are not fair prices. So I would just ignore it when you do this. The problem though is watch out for the G&A expense that hasn't been allocated anywhere else because that's not intra-company. It's just extra expenses that somebody has to bear. Any questions about asset-based valuation? So 2018, I tried to do this for GE and it was a nightmare. But 2018, GE was well past its glory days. So I took them down. You're saying why the different colors? I know they're really ugly colors. The green are the businesses where they were earning a return on capital higher than the cost of capital. The yellow are the ones where you're pretty close, and the two pink are the businesses where they really should get out of the business, basically. So it's a kind of mix. It's a mess when you look at the numbers. So I actually did a intrinsic valuation of each of the parts. And here was the challenge. I got a value for the business of 204 billion, but that was after I looked at the GE capital, which had a value of 27 billion, but carried debt of 85 billion. So the net effect of GE capital was a minus $48 billion. Or minus 48 billion, right? 2785. Yeah. 58 billion. Minus $58 billion drain on value. You're saying why didn't they just shut down GE Capital? It was draining the value by 58 billion. Because it was mixed up with all the other businesses. The GE Aviation, almost every contract was underwritten by GE Capital. GE Capital became this albatross. GE could have been wound up and sold for a lot more 10 years earlier than it was, but GE Capital has made it almost impossible to do until they got really desperate. Okay, so here you can see the bulk of the value, and there are good businesses, average businesses, bad business in the mix. And that's the nature of conglomerates. You're going to get a mix of businesses, some good, some bad. And if you throw a capital arm in there, then it becomes really difficult to disentangle these businesses and break them up into pieces. Now, GE eventually did it, but it took them a long time to get there. I did also try pricing the part, same effect. GE Capital was still a drain, but here I looked at the peer group EV/EBITDA, but that's very blunt pricing because GE didn't give the kind of information at the divisional level that would allow me to do a better pricing. Again, so when you do sum of the parts, so somebody says sum of the parts, ask them, do you want a sum of the parts valuation or a sum of the parts pricing? If it's a sum of the parts valuation, then you have a lot of work to do, right? Each part has to be valued separate, its own cash flows, its own growth, its own risk. If it's a sum of the parts pricing, it's a little easier, but you still have to go to peer groups, pick the right multiple within each. And you can have different multiples for different businesses and ultimately add them up. Yes, Michael.
I know you value Tesla a lot. Do you apply some of the parts for?
It's tough in Tesla to separate them out, right? I mean, are you talking about the robotics and automated driving as separate parts because they're not even existent right now? They'll all be in the future, right? I think of them more as options than as businesses right now. Neither is a standalone business, neither is even a business yet. We don't even know what the real business. At some point in time, if they become businesses, would you do something? Absolutely, it would be all. I think NVIDIA, effectively, I did some of the parts, right? I did the AI NVIDIA and the rest of NVIDIA separately. And there I had to draw some lines in the sand myself because NVIDIA didn't break down some expenses into AI chip expenses. They just do R&D, right? It's collective R&D. So if the information is not there, you're often drawing lines yourself, and then you wonder whether, is it worth it even doing it? And that's why most of the time I value the entire company. Okay? We talk about some of the parts. Can you value Coca-Cola as the sum of its geographical parts? Yeah, you can value the Asian division separately. You know why this might be worth doing right now? If this trade war thing reaches its natural climax and basically companies are not able to run division, because remember, until the 80s, all multinationals used to have subsidiaries that were standalone subsidiaries in most countries. Nestle had a Nestle India that traded separately as a company, had its own board of directors. It's an incredibly frictional system, right? Because now decision, but it allowed them to separate companies in different parts of the world and have this plausible deniability. Coca-Cola US is only in the US, and you have all these other businesses, but we don't technically own them. We have an ownership stake. Hopefully, we don't go back to those days because, as I said, it's a very inefficient way to run a multinational. But if that happens, then you might have to start thinking about geographical mixes of each of these geographies having a different value, and you own 60% of the Indian subsidiary, 40% of the Thai subsidiary, and add them all up at the end. Make it a nightmare to actually value companies to do it. I'm going to set up private company valuation because I know we kind of roamed through a lot of pricing today. First, I mean, let's set the table. The process of valuing a private business is really no different from the process of valuing a public company. You got to make a choice. Do you want to value the entire business or do you want to value equity? If that sounds familiar, that's how we start public companies. But there are two issues with private businesses that'll make valuing private businesses different and potentially more difficult. The first is the absence of a market value for equity. You know what they say, you don't know what you're missing until you actually miss it. In public companies, we take it for a given that you have market value of equity. You have no market value of equity. We'll see where in valuation that's going to come into play. Second, at least in smaller private businesses, the financial statements might not follow IFRS or GAAP, which means you have a little bit of gaps to fill in on your own. So let's start with the market value question. Why does it matter that you have no market value of equity? First, we use market values as inputs in valuation, right? Where when we do cost to capital, what are the weights supposed to be on equity and debt? Market value of equity, market value of debt. We miss it. Second, market value, once you're done valuing a company, what do you compare it to? You compare it to the market value. And if you have a company that's not publicly traded, you're going to come up with an intrinsic valuation of your company or pricing for your company, but you have nothing. You're saying, so what? When you did your intrinsic valuation, you know the signal that you've done something horribly wrong usually was? When you got your intrinsic value, you got $2 per share. The stock was trading at $2,000 per share. You know, markets make mistakes, but this is not likely to be a mistake, right? Probably a mistake on your part in terms of units somewhere. It's nice to have a market price to compare to because then if you've really screwed up, it'll give you an indication. And we didn't use this, but a lot of risk-based measures are market price-based, right? If you run a regression beta, you need past prices to get them. So that's the first challenge, no market price. It's going to leave you feeling a little unmoored. Second, on the cash flow question, 4 basic problems. First is, many private businesses have not been around as long as publicly traded companies. It's not always true. In fact, the oldest business in the world was this Japanese shrine repair called Kogumi. It was 1,500 years old when it shut down. So some private business has been around a long time. And I don't know whether the MBA still do it, but until a few years ago, they used to have these auctions where they used to auction off what professors would offer. What do professors offer except a service? So I offered to value somebody's company for them. They won the auction. So somebody wins the auction, pays $2,000. And I'm laughing, paid $2,000, small private business. The guy shows up with a stack of papers, which is like 1,000 pages thick. And I said, who am I valuing? He said, we make rum. I said, okay, where are you located? He said, Miami. I said, by any chance, is your company's name Bacardi? Turned out there was a Bacardi guy whose nephew or niece, part of the family was here. It's a privately owned business, 300 years of history, right? But most of the time with with private companies, you have less history. Second, you do have differences in accounting standards across private businesses, especially small private businesses, that can be wider than differences in public companies. I still remember somebody in this class about 10 years ago who decided to value a mother's flower shop as her project. She said, I said, go ahead. 6 weeks in, she comes in my office, I have to change companies. I said, what, you had a fight with your mom or something? She said, I went to my mom and asked her for her financials. And she took me into this back room where every wall was covered with Post-it notes. I said, Mom, what is this? She pointed to one wall and said, that's my revenue wall. Every time I sell something, I put a Post-it note there. There's my expense wall. I don't think Post-it note accounting is part of IFRS or GAAP, but if you're a small private business, you have a flower shop to run, who has the time to keep accounting books? Right? She actually ended up valuing the flower shop in spite of the Post-it notes. The third, and this is not exclusive to private businesses, but small private businesses, the line between the personal and the business becomes a very gray one, right? There's a company car that every evening seems to disappear around 3 o'clock when school lets out, picking up the owner's kids. And you have to draw the line. This is how much, and this, you're not the tax guy trying to figure out how much of this is actually an operating expense. And finally, and this is a critical one, many privately owned businesses, the owner does not charge himself or herself a salary, and this can become an issue. Do you see why? Even if the income statement is well done, it follows accounting standards, and the owner does not charge themselves a salary, what you're seeing reported as income is really not the income of the business. I mean, on Shark Tank, this is always the funniest part of Shark Tank, right? We made $50,000 last year. There'll be 4 people up front saying, did you pay yourself a salary? No. So basically, each of you worked for $12,500 last year as your salary. But because as an owner, you say, why would I pay myself a salary? Because I get whatever's left over. So we have to talk about how to impute that expense in before you value the private business. Otherwise, you're going to overvalue the private business. None of them are insurmountable problems, but they can make private company valuation messier. So here's the last thing, and we'll end with this. If anybody ever asks you to value a private company, let's remember about 20 years ago, sitting in my office, this woman barges in, opens the door, walks in as if it's her office. She said, I heard you teach valuation. I said, I teach corporate strategy. I was trying to escape whatever she was going to ask me. She said, no, I know you teach valuation. I said, okay. She said, can you help me value my business? And I said, why? She said, what do you mean why? I said, why do you want to know a value? Is it because you're curious? Sometimes you own a business. Is it because you're getting divorced and you have to pay half of this value to your spouse? Is it because the tax guy is after you and you want a number, so you have to pay 30% of that number? Or is it for a transaction? She said, will that matter? I said, absolutely. If you're getting divorced, you probably want a number close to 0, and I might not be able to give it to you. Tax guy, similarly, want a low number. Motive matters in private company valuation. And the sooner we accept that, the healthier the discussion becomes. She finally got around, she said, oh, for a transaction. And I said, to whom? She said, you have a lot of questions. I said, I need to know that as well. You say, what do you mean to whom? I said, is it to an individual? Is it to another company? Is it to a private equity investor? Because the number I'm going to give you is going to be different. Already you can see why AI is going to have a tougher time with good private company valuation than public company valuation. Because you almost have to gauge what your setup is before you can attach a value. So on Wednesday, when we come back, here's what I'm going to do. I'm going to take a restaurant owned by an individual and value it for sale to another individual. And then I'm going to ask the question, will the number have been different if I value to a company or to a private equity investor? And we're going to see vast divergences in value based on who the potential buyer is. So I would see you on Wednesday. No. And remember the quizzes next Monday. I sent out the review session and the past quizzes. Did you get that yesterday?
So like.
No, but
Getting worse.